We'll continue our discussion on dividend discount model. Before we proceed, let's discuss what we have done so far. We started our discussion with what dividend discount model, in which we introduced you a couple of formulas in related with dividend discount model, and we need to basically discount. Future dividends arrive at the present value of these dividends, and that would represent the value of our stock. What I mentioned was these dividends are very difficult to arrive at. The information is not available. So we use Gordon growth model, in which value is defined as dividend of current multiplied by 1 plus the growth rate divided by R minus G, where R is cost of equity and G is again the same growth of dividend. This formula is really useful because we need not get into each and every year to arrive at this. Let's say we are on 5th year, so we have visibility on these years' dividend. We can apply this formula in this year, and what it does is it will basically give you value of all the future dividend at this time frame. And you already have dividends for this, so it will become easier for you to calculate the current value of a stock. Let's discuss some of these strengths and limitations of the Gordon growth model, although these are somewhere covered in the assumptions. But as I mentioned Gordon growth model, you need to be very particular that you're applying this model to a stable, mature, and a dividend-paying firm. A company which doesn't have plans of paying dividends, or if a company doesn't pay any dividend, then Gordon growth model cannot be applied. With respect to limitations, cost of equity needs to be more than the growth in dividend. The value of a company is very sensitive to the values of growth and the rate. Let's see this practically. In this example, both companies have a dividend expectation of $10 and $10 next year. The rate is 10% and 9%, and the growth is 7% and 8%, and when we apply Gordon growth formula, that is a dividend expected to be paid out next year divided by rate minus growth, we get $333 in case of Company A and $1,000 in the case of Company B. So we clearly see that 1% of change of rate here has led to this. Let's see in case if the rate is just 10% and only 1% change in growth. So in this everything is common, only 1% change of growth varies from A to B, and which indicates close to half a value of Company A is increased in case of Company B just by changing 1%. Just by growing the dividend growth by 1%, we see that the value has drastically increased by 50%. And we are looking into this point, which says that it is not useful for non-dividend paying stock. So this links back to this point, which is this Gordon growth model is applicable to a stable, mature dividend paying firm. In case the company doesn't pay dividend, it cannot be applied. And the last limitation we look is that it is not useful for multi-stage growth firms where growth changes. As you can see that we are applying the formula as dividend of next year divided by return minus the growth in this growth. If this number changes, then this formula will not hold. You will not be able to apply this formula because this formula takes care of future values throughout. This has to be one single value, and you cannot expect this to change a lot. The growth is very much predictable and it doesn't change. In case it is changing, then Gordon growth model cannot be applied. So what we have gathered so far is primarily that in dividend discount model, fundamentally we are doing discounting the future dividends to the present value. We are expecting the share price to go up basis our present value estimate, then we buy those shares. Arriving at these numbers is really difficult for any analyst. So what we need to do, and we also discussed about Gordon growth model, which says, any dividend we arrive at, we take it to the next year, the expected in 1 year, and be divided by R minus G, gives a future estimate of this value. If growth is varying too much, then GGM cannot be applied. So, if a company's growth rate is very high initially and after that growth rate will come down a little for a few years, it will stay like this and then it will stabilize. 1 to 2, 3 years, for 5, 6, and so on. This basically represents the rate or the growth. What it really does is there is a step down to the growth levels. This stage growth will be constant throughout, will not be logical, but practically speaking, it will stay like this. It will gradually come down. So what we need to do is basically look into a company's valuation from this perspective that growth will not be constant. If it is a new company or a new product, probably the growth will be high. Then gradually there would be more competitors entering in. The growth will go down, and then probably the consumer tastes and preferences might change, or there are a lot of other competitors in the market and it will go down further, and accordingly, the growth will go down south. This is one basic thing which we need to keep in our mind before we proceed on this. In the next section we'll try and fit this scenario.